Okay, welcome to the November 2022 market update. Quick bio page. Go through this every time, so just a quick snapshot of who I am. So I'm going to kind of jump into things here. The market had a really nice month in October. The S&P 500 was up just under 8%. Nasdaq up just under 4%. Bonds still struggled though, down 1.28, and then 20-year Treasuries down almost 6%. High yield, so high yield bonds actually were up though 3%. So there were certain areas of the bond market that did pretty well. This being pulled higher, probably. Most likely by energy stocks did really well in that environment, and high yield bonds are typically are very much tied to the energy market, so that helped out. But bonds still kind of struggled to find their footing, and then year to date, this is through the end of October. S&P still down just under 19. Nasdaq down, close to 30. And then as, mentioned here, bonds, still struggling throughout the year. Although, today's a really interesting day in the market. This is Thursday, November 10th that I'm recording this, and the market's up I think the S&P's up 4.25, and bonds are up about 2%. Inflation data came in today lower than expected. So that was really helpful moving forward. So just kind of quick update. Obviously, October, really good bounce in the market. And I mentioned last month there were some things that were turning that we wanted to see kind of continue, and they did throughout the month. So that's a really good sign. But still obviously very challenging year. So this is a chart, right? Just going back to U.S. presidential cycles from 1970 through 2022, right? And just looking at first year, second year, third year, fourth year, where we're at from the term. And the second year is historically the worst year. And the next slide I show will kind of get into break it down by quarters. And I mentioned this in the last webinar that the fourth quarter during those midterm years, right? So which would have started October 1st of this year, whereas the full year is usually pretty typically challenging. The fourth quarter is historically one of the strongest time periods during the entire presidential cycle, that 4-year presidential cycle. So historically speaking, again, that doesn't mean that, it has to happen, but historically speaking, the market has a rough year during the second year overall, but the fourth quarter is usually really strong, and when the market does turn, and we did see that happen beginning in October. And then this breaks that down. So the circle here is the full second year term, right? And this is quarterly. So first quarter, second quarter, third quarter, and then here's that fourth quarter right here. Right. And then this shaded area is just showing those next few quarters here. But this is where we're at. Right. And so this would have been October, November, and through December. And we can say again, right, we know that October was a really strong month. Had really good returns for the S&P 500. And November's been a little bit of a whipsaw so far, but today with the market being up 4.25, lower than expected inflationary data, the majority of the midterm, elections behind us here, the market has started to kind of take off here. So hopefully that continues over the next few quarters like it historically has. There's, anything can happen. And again, you can't base your entire investment premise off of this, but it's nice to know from a seasonality aspect where things kind of historically go. So, one of the concerns, obviously, people talk about recessions. Are we in? Have we kind of been in one already, or are we headed towards one? This is the yield curve, right? The difference between 3-month and 10-year Treasury yields, and so every time that it inverts, right, you can see that historically speaking, a recession follows not too long thereafter. So the shaded areas are when a recession hit. Now, obviously, when this line hits 0 or below, that's when the yield curve is inverted. And so you can see that typically is a pretty good indicator that at some point in the near future, we'll probably hit a recession. and the yield curve did invert. So a lot of people are expecting a full recession to hit sometime next year, kind of second quarter kind of thing. And so we'll see if that happens. But again, something to pay attention to there. Yield curve has to do with treasury yields. The difference between this particular one is the 3-month and the 10-year treasury yields. And so that is something to just kind of keep your eye on, that the fact that inverted. We've already seen a little bit of a, very difficult time in the market. Is, will a recession actually hit, sometime next year? Now, if I think, again, I've said this in the past, if a recession hits, it doesn't necessarily mean that it's like 2008 where, everything's falling apart and the market, cracks by 56%. There's some recessions where, it's fairly mild and the market is even flat or up during those time periods. But you certainly don't want to go into a recession, right? I mean, obviously that means the economy is slowed down and people are losing jobs. Income is not going up. So we don't want to see that environment. This is a quick chart showing offensive versus defensive sectors. Okay, so this particular chart is the line on the top is it's technology plus consumer discretionary divided by healthcare plus consumer staples, right? So we're taking two very offensive sectors that do really well when the market's, in a great spot, and dividing it by two more defensive sectors. In a really healthy environment, you'd want to see this line going up, right? And so this is when the market bottomed out in March of 2009. Obviously, this is a great time period in the market. This line has been coming down for a while, since kind of mid 2021. And so we're still seeing the defensive sectors lead. And that's not typically what you want to see in a healthy market environment. So even in those up months where, October, where the S&P 500 was really strong, we are still seeing some defensive sectors lead in those environments. And so that would typically say that, hey, we might not be at that bottom yet, even though we are having a rally. You really want to see those offensive sectors kind of come out really strong. Today that is happening. We'll see if that kind of follow through happens, but longer term, we haven't seen that quite yet. And then I always, I've shown this in the past as well. This chart is actually from the October webinar. I just want to show where this has gone. So this is high beta divided by low beta, right? So similar to an offensive versus defensive, high beta means more volatile stocks that are going to do really well in a healthy market environment, divided by the low beta stocks that are going to have a little bit more defensive in nature. And I said that last month, I said, hey, we're starting to see a little bit of a momentum shift here where you're not seeing low beta significantly outperform high beta. This time period, that was the case, and they did bounce off a little bit, the high beta stocks. And from just a pure momentum aspect, we did see that kind of break through. So we wanted to see continued follow through, or at least not see this break down as much, right? So even if you don't see as a really strong follow through, as long as it doesn't completely break down, that's still a really good sign. And so this is from October, right? So this is not the updated one. And then this is where it went, right? So it was here, and then this is kind of where it went. And so again, we didn't see it break down. That's really good. Nothing to get excited about, but it didn't collapse. Typically if high beta stocks are collapsing, that's a really, really bad sign for the market. And that really wasn't the case. And SPHB is up huge today. So high beta stocks are just absolutely flying today. So that's a good sign. But again, you're going to see those really big swings in bear markets. So we want to really, what's most important is to see, what sectors are following through and kind of if that continues. Just a one-day swing doesn't really mean a whole lot at all. High yield credit spreads, I talk about this all the time, really important. This chart is also from the October webinar. And in that webinar, I mentioned, hey, we haven't seen the credit spread spike. They kind of been sitting at that level down here around 5.5. And we haven't seen that spike yet. So that's a really good sign. This is from October again. So we were kind of watching in October, even though the market had a really good rally in October, we want to make sure that we didn't see high yield credit spreads go up. And we really didn't. We continued to see sorry, this is the next chart. We actually saw them come down um, over that month, and that's a really good sign. So we really want to see high yield credit spreads continue to come down. That would be an awesome sign for the market. Really important that we don't see those shoot up. So it's good that the volatility within credit spreads has certainly kind of come down a little bit. This is just a quick chart updating, kind of showing everybody here, although bond volatility has slowed down a little bit, the selling has continued. It hasn't been as strong as it was earlier in the year, but it hasn't bottomed out. This is AGG, which is the Barclays Bond Aggregate Index. So kind of essentially the S&P 500, but for the bond market. And it just, continues to fall. I mean, this has never happened in the history of the bond market, the environment that we're going through right now. So really want to see that kind of come back. And then this is the reason that we're going through that, right? So if you look at this chart, AGG down significantly this year, again, before today, down about 16% on the year. It's not the level of interest rates. So here, this is TNX, which is the 10-year note. So, interest rates with being where they're at, yes, they're much higher than they were, a year ago, 2 years ago, 3 years ago, but they're not at absurd levels of 10, 11, 12%. It's really the rate of change, right? You look at this chart and you see where interest rates were a year and a half ago, and it's how fast they rose, right? So how high, basically how much they rose over such a short period of time. It's that rate of change that just went parabolic, basically, and that's really what happened. That's exactly why this happened with the bond market, right? And so with inflation coming in lower than expected today, that's a really good sign, because you would hope that maybe the raising of interest rates will slow down over the next, 3-4 months. If that's the case, you should see bond volatility minimize, which would help the bond market find a floor. I don't think equities can completely take off until the bond market stabilizes. So hopefully we see interest rates at least come to, even if they do have to do another 1 or 2 hike in rates, that maybe it's not 75 basis points, maybe it's less. That would be a really good thing. The futures market for interest rates has been pricing in that they would be done raising rates sometime like February, March, April of next year. So I think that's maybe what, with the inflationary data coming in lower than expected today, that is, I think, probably on everybody's mind, is saying, hey, maybe even though inflation might be at an elevated level for a while, maybe the increases are done. So that would be very helpful. And then this is the move, right? So this is the volatility index for the bond market. Like high yield credit spreads, right? We haven't seen bond volatility continue to spike, which obviously that's what we want to see. That's a great thing. But we definitely want to see it come down. And again, that would have to do with interest rates. If interest rates can stabilize, bond volatility will come down, bond market will find a floor. You should see equities, take off in that environment. So that would be a really, really bullish for equities. That's really what we want to see. And then that's it. There was not a tremendous amount of kind of changes from last month of what's going on in the market, other than kind of the news that came out today. So I just want to kind of update everybody on what happened in October, where we're at kind of year to date. And then, the same things to kind of pay attention to. I didn't include, in this month, the US dollar, right? Again, really important to kind of pay attention to what's going on with that. That's been inversely correlated with equities. And, the equities are up for right around 4% today, and the US dollar is down like 2%. So that relationship still stays intact. So I think that's really important to pay attention to. The high yield credit spreads, bond volatility, and really just kind of those offensive versus defensive relationships. So high beta versus low beta, just continuously paying attention to what's going on with those things to help figure out where we're at within this particular cycle. So if you guys have any questions, let me know. Or if you want to see any updates on anything else moving forward, shoot us an email. Have a great day.